Welcome back. We've got Janet Hugo from Hugo Capital joining us for more Investment 360. And in light of Valentine's Day, Janet, and also, of course, with my conversation with Anne Lepile from Investment Solutions last night, we were talking about fund managers having to find innovative solutions to this lack of yield. They're going to have to be looking far and wide for assets that return a better yield, for want of a better word. Let's start with jewelry. Have people been coming to you and saying, shouldn't I be putting jewelry in my portfolio? A couple of carats of diamonds.
I'd love them to come and say that to me. But no one should be putting jewelry into their portfolio. You can look at jewelry in terms of collectibles. After about 30 years, they start to regain the value that they had. If you went out and bought something today, you would expect 30% for it tomorrow. So jewelry just doesn't have that intrinsic value that is there tomorrow after you've driven it out the shop door.
Almost like cars.
Sadly.
You're not going to buy a car for an investment. Diamonds, same scenario.
Similar scenario, but here we have this wonderful thing of Anglos very hungry after De Beers, so they must be seeing something in the diamond market. And China is incredibly strong, looking for diamonds. People with cash are now saying it's a great thing to be buying, and it shows you have wealth. So yes, it's probably there on the investment horizon, but if you wanted a return from it quite quickly, maybe your only way to do diamonds would be via Anglos and De Beers.
Buy the shares. Yeah, look, diamonds are always a good investment until the day you come to sell them.
Exactly.
Well, that's what we're saying.
Then you get to buy and try and find a buyer for it.
Yeah.
Completely illiquid.
Yeah. You know, collectibles become something that you buy with a brand name. So the Cartiers, that kind of thing, the Tiffany's that have been around for years, that becomes a collectible. But even then, you've got to wait that time horizon out, 30, 40, 70 years, for it to be valuable again.
So again, it's the liquidity aspect. You can't buy and sell immediately.
There's a big argument overseas about hard assets, old motor cars, because, you know, if you look at the prices some old cars have been getting, they've just been going stratospheric. But that's probably just a reaction to economic circumstances. I mean, that's not sustainable. It's got to come down. In fact, 3 or 4 months ago, there was the first private equity fund, I think it was £300 million, the first private equity fund that's only going to buy old cars and hopefully sell them at a profit. This is a passion of yours.
Can I disclose? This is a passion of yours?
No,
You've got a number of old cars in the garage.
I don't do it for investment. I do it because I like old cars. But there's one thing about owning an old car. You're probably not going to lose money. I don't think you make money, but you're probably not going to lose money. Whereas on a new car, you know, you drive it out the showroom, you've lost 30%.
That's true, but your maintenance and your insurance and your looking after that old car has to be a passion.
Oh, yeah.
It's the same with art. If you're going to buy a painting, please really buy something you enjoy looking at.
The bottom line is that art, from a value perspective, only yields value when the artist dies. So you could be waiting a very long time, generally speaking. That's a generalization.
There are a couple of artists at some of the galleries at the moment who are earning wonderful fees for their art, and they deserve it. It's beautiful work. But yes, the huge scream up in value will happen when they die.
And you also have the liquidity element again then.
Exactly.
You cannot sell the assets. We were chatting before you came into studio and we're talking about alternative investments. Wayne gave whiskey the thumbs up.
Yeah. Oh, well done, Wayne.
And I was looking at some research provided by my producer. One of those rare whiskies out there, 1996, was bought for £80 and sold in 2010 for some £2,000. You can't sneeze at that return.
But you must just be careful if you collect whiskey. You mustn't like it too much.
So when I take it, you don't collect
whiskey. You've got to keep whiskey to make money out of it, because the empty bottle doesn't get too much of a return.
Where
Janet,
would
have
you
you
sell
been
a bottle of whiskey?
Oh, no, there's big markets.
Is there?
There's big markets, like the same as old as real collectible wines. No one actually drinks it, but, you know, 1940 or 1812 when Napoleon invaded Russia, you know, these things are worth fortunes.
Janet, let's talk about what people are asking you in the current environment. Yeah. This argument that Anne Lepile put forward yesterday, and which is what we've based our discussion on now, the search for alternative investment assets.
Yes.
Are you feeling that drive from your people, from people that you're speaking to?
In these uncertain economic times, we have to be looking at a diversification of assets and investment portfolios. So for today, the best thing that your husband or spouse or lover or Valentine could give you is probably a Kruger Rand, because that's the closest value to gold that I could find in jewelry. So the gold price at the moment is...
it's $1,700 an ounce, give or take.
Okay, but if you looked at it in Kruger Rand ounces, you'd be looking at about a 300 Rand premium to gold. So it's not that much. Whereas if you were going to buy a piece of jewelry, you would expect to pay for the jeweler's artwork about a 250% premium, and some of that's going to be vatable. So it's an expensive outlay in something that's just going to crash in value tomorrow, whereas your Kruger Rand will be there tomorrow. So if we stay with a Valentine's gift. But in general, your diversification of portfolio will ensure that you have a diversification of returns and probably a more consistent portfolio expectation.
And what about cash holdings in light of our discussion with Malcolm Charles and inflation at above 6%, the fact that we're now looking at negative real yields on cash? Are you saying to people that they shouldn't be holding vast amounts of cash in the current environment?
Oh, it's difficult because you use cash to balance portfolios and you use cash to take risk out of portfolios. So cash and bonds and income type portfolios will help take risk out of a portfolio for a client. It's difficult to say that it's a bad place to be at the moment until we get certainty in the markets, until we get a real focus on the direction, and people willing to accept the risk. Then you can say cash is a bad thing to have.
But right now you believe you should be holding it in your portfolio because your entry point into other assets effectively.
Exactly.
Wayne?
Yeah, look, I mean, we're very neutral on just about all the risk assets. We're very negative on developed market bonds, but otherwise we're fairly neutral because valuations, quite frankly, are fairly neutral. So we're carrying a fair amount of cash in our portfolios. But I mean, understand this negative real interest rates or low yield environment is part of the whole answer of eventually the economy is recovering and getting better and the move into risky assets. So this is, it might be protracted, it might be, the extent might be massively exaggerated, but this is a very normal cycle we're going through here. You know, economies do well, inflation picks up, interest rates pick up, then it all falls in a heap, and interest rates are cut. The economy eventually picks up again. So this is a very normal cycle.
But everyone's talking about this changing world, this new low yield environment.
No, it's just the duration of it. We've had low yields plenty of times before. We've had negative interest rates, quite a few, not in South Africa necessarily, but certainly overseas. This might be an extended duration, but it is in reality a normal cycle. I'm not one of these.
It is going to be an extended duration.
Yeah, no,
Look
totally.
at how the US are keeping their funds rate low.
I'm very cautious of the new age and the new thing and the new this and the new that. It's by and large, there are changes, obviously, but by and large, it's the same cycle repeating itself.
Janet, if you like Kruger Rands, then you must like gold.
I love gold. It's been so darling in the last couple of years, but you have to be careful. It's not a big chunk of a portfolio. And
do you use it as that a hedging element against uncertainty?
Of course, it's always been that sweetener as a hedge in a portfolio against uncertainty. And the cycles, as Wayne says, it's been there in the cycles forever.
Do you go through the new gold ETF, not the gold stocks? If you were advising people?
Different for each client. And yes, that new gold ETF is wonderful.
Yeah, look, I mean, gold shares, our gold shares in South Africa, and we discussed this so many times, are quite unique. The gold's running out and what's left is very, very deep. So although the gold price does that, the mining costs are going up quicker than what the gold price is going up in rand terms. But physical gold's a very different story. But there's one thing about the ETF.
What is that?
You can't hold it. Whereas Kruger Rands you can put in your hand and stroke it before you go to sleep at night time. ETF you can't, it's just a piece of paper.
I see where this whole discussion is going. It was started and fueled by the Kruger Rand as a perfect Valentine's Day gift. You love to stroke your Kruger Rand at night.
I don't own a Kruger Rand. I'm just saying, I mean, if you want gold, because gold is just nice to hold, so you might as well buy some Kruger Rands.
Well, I hope that's
a tangible,
for your
portable
wife.
asset.
Yeah.
It's a tangible, portable asset.
Yeah.
Well, let's leave it there as the perfect Valentine's Day gift.